Welcome to the Deep Dive. Today, we're jumping into a company pretty much everyone interacts with Amazon, ticker AMZN.
Hard to avoid them, really.
Exactly. We've got our hands on a pretty detailed financial analysis and investment report. Our goal here is simple. Unpack it, pull out the really crucial insights, clarify that complex business, and give you the key takeaways from this specific analysis.
Right, because there's the Amazon you think you know from shopping, and then there's the intricate machine underneath that this report digs into. Understanding that difference is key.
Okay, let's get into it. The report kicks off by describing Amazon as a symbiotic dual engine. Sounds pretty significant. What does that actually mean according to this analysis?
It's really the core strategic idea here. Think of two huge connected engines. First, you've got the retail engine, that's the online store, the logistics, Prime, Whole Foods, basically everything most people see day to day. It drives massive revenue and brings customers in.
And it is absolutely enormous.
Huge. The foundational e-commerce online stores was still the biggest piece in FY 2024, like $247 billion, almost 40% of the total revenue.
Wow.
But what the report really stresses within retail is the third-party seller services. That's other businesses selling on Amazon. That hit $156.1 billion, about 24.5% of revenue. And critically, it's much higher margin than selling their own stuff.
Ah, okay. So they make more when others sell on their site.
Generally, yeah, through commissions, fulfillment fees, things like that. And it's a big part of the business now. Over 60% of physical goods sold on Amazon are from third parties. Then you layer on physical stores, Prime subscriptions, which was another $44 billion or so, keeping people locked in.
So retail is scale, reach, customers.
Right.
With that profitable third-party layer.
Right.
What's the second engine then?
That's the technology and services engine. And the star there is Amazon Web Services, AWS. If retail is the growth engine, this report absolutely paints AWS as the profit engine. World leader in cloud computing infrastructure services for businesses.
Right. And revenue-wise, it's smaller than retail.
Oh, yeah, significantly. About $107.6 billion in FY 2024, maybe 17% of total revenue. But, and this is the crucial bit, the margins are incredibly high, often over 30%.
30% compared to retail.
Exactly. Retail margins are razor thin. The report points out that in 2024, AWS generated over half of Amazon's total operating income.
Okay, that's where the symbiotic flywheel idea must come in. How do these two, totally different businesses fuel each other?
This is the brilliance that the analysis highlights. The huge profits from AWS basically subsidize the low-margin retail side. Amazon can afford rock-bottom prices, massive spending on warehouses, super fast shipping, precisely because AWS is throwing off so much cash.
So AWS profits are paying for my vast Prime delivery?
Largely, yes. The 2024 operating income numbers in the report make it clear. North America retail made $25 billion. International retail, just $3.8 billion. AWS, $39.8 billion alone.
Wow.
That AWS cash flow lets them dominate retail on price and speed. And that dominance pulls in more customers and sellers, creating more data, more traffic, which then fuels another high-margin business the report calls out.
Advertising.
Right.
The report flags that as a third profit center emerging fast.
Exactly. They leverage all that shopping traffic and data. Advertising services pulled in $56.2 billion in FY 2024. And the report says it's exceptionally high margin and growing incredibly fast.
So it's like a three-part system. Retail for growth and contact, AWS for profit and tech, and ads layered on top, fueled by the retail traffic.
You got it. It's a really interconnected, powerful system, much more than just an online store.
Makes total sense laid out like that. So given this unique structure, how dominant does the report say they actually are in their markets?
Extremely dominant. In U.S. e-commerce, a staggering 37.6% market share. The report notes the next biggest is Walmart at just 6.4%. Globally, they're the biggest online retailer, period.
And in the cloud, AWS.
Still the leader. Around 31% global market share. It's basically an oligopoly, the report says, with Microsoft Azure maybe around 25% and Google Cloud near 10%.
Are these still growing markets? Or are they mature?
Oh, definitely still growing. High growth. The report projects global e-commerce to grow at almost 19% a year through 2030. Cloud computing, even faster, over 20% CAGR projected. Think digital transformation, AI, IoT, it's all driving cloud demand.
And getting into cloud is tough, right? High barriers.
Extremely high. The capital needed for data centers, the technical expertise. It's not easy for new players to just jump in.
Okay, let's shift to the money flow, because the report highlights something really unique, this negative cash conversion cycle. Calls it a financial fortress. Negatively sounds bad, though.
Usually, yeah. The cash conversion cycle, CCC, is just how long it takes to turn resources, like inventory, into actual cash from sales.
Hmm.
Most retailers buy stuff, hold it, pay their suppliers, then sell it, and wait maybe 30, 60 days to get paid by customers if they're selling wholesale. That's a positive CCC. Money is tied up.
Right, so Amazon flicks that completely.
Totally flips it. This is genius. When you click buy, Amazon gets your cash instantly, right
Yeah.
away. But because they're so huge, they negotiate long payment terms with their suppliers. Maybe 60 days, 90 days, sometimes even longer. So they're holding your cash long before they have to pay for the goods they just sold you.
How long does the report say?
Well, it quantifies it. Around negative 35 days in Q1 2025.
Wait, negative 35 days? So they have the customer's money for over a month before paying the supplier. That feels like free money.
That's basically the financial fortress idea. Every sale generates cash up front. It creates this massive pool of cash, like an interest-free loan from their suppliers. It means their own growth funds itself. They can build warehouses, invest in AWS, fund new projects without constantly needing banks or investors. Incredible flexibility.
That is a huge, almost hidden advantage. Does it make them less vulnerable to economic downturns?
It definitely provides a big cushion. The business overall is, moderately cyclical. Retail definitely feels it when consumer spending slows down. But that negative CCC provides a constant source of liquidity, which helps smooth things out. AWS is less cyclical too. Businesses keep moving to the cloud for efficiency, often regardless of the economy.
What about seasonality? Still big holiday spikes?
Oh yeah, very strong seasonality. Predictable though. Q4 is massive with holiday shopping, and Prime Day gives Q3 a big artificial boost too.
Okay, let's look at the actual financials presented. The 5-year trends show massive growth, but there was that dip, that net loss a couple of years back.
Yeah, the scale is just wild. Revenue went from, $386 billion in 2020 to over $650 billion TTM. Consistent, strong growth. That 2022 net loss of about $2.7 billion, the report is clear. That was not from the core business failing.
No. What was it then?
It was mostly a non-cash write-down on their investment in Rivian, the electric vehicle maker. The stock price dropped, so they had to record a loss on paper.
Ah, okay. So the actual business, the engines we talked about, we're still making money.
Exactly. And the report points to operating income as the better measure of core health. That number bounced back incredibly, from $12.2 billion in 2022 to over $79 billion TTM. That shows the underlying profitability roaring back.
And cash flow. They were investing like crazy for a while, weren't they?
They absolutely were. Operating cash flow is super strong, $113.9 billion TTM. But free cash flow, which subtracts those big capital investments, was negative in 21 and 22. They were basically doubling their entire warehouse network globally. Huge spend. Now, the report shows a massive rebound. Free cash flow is over $50 billion TTM. That means those huge investments are now paying off, generating serious cash. That's a really positive sign.
Strong revenue, operating income recovery, FCF rebound. How do the ratios look compared to others based on the report's benchmarks?
It really shows that blend again. Profitability, gross margin around 49%, net margin near 10%. That's way better than a pure retailer like Walmart, but not quite as high as a pure software giant like Microsoft.
Right, it's in the middle.
Exactly. And the key trend the report flags is margin expansion. AWS and advertising are growing faster, pulling those overall margins up over time. Return on equity looks strong too, 23.3%, beating Walmart.
What about the balance sheet? Debt to equity looks really low, which is good. But the current ratio seems low too. Is that a worry?
The low debt to equity, 0.17, yeah, that's great. Very conservative financing. Now, the current ratio, 1.05, it looks low if you compare it to a traditional company. But the report stresses this is not a sign of distress for Amazon.
Why not?
It's a direct result of that negative cash conversion cycle. They owe suppliers a lot of money, accounts payable is huge, but that's acting like free financing. They just don't need a ton of cash sitting around or lots of current assets because they collect cash so quickly and pay so slowly. It's actually a sign of financial strength and efficiency for them.
Okay, that makes sense. It's counterintuitive but powerful. So how does the report actually try to value this beast? It seems so complex.
They use a two-pronged approach: intrinsic value, using a discounted cash flow or DCF model, and relative value, comparing its market multiples to peers.
So what did the DCF suggest?
The DCF involves making assumptions, right? Like retail growing around 9%, AWS maybe 17.5%, advertising even faster at 22%. Using a discount rate, the WACC, of 9.5% and a long-term growth rate of 3%, the model spits out an intrinsic value per share of around $245.90.
Okay, $246 intrinsic value. How does that line up with how the market prices it relative to others?
This really shows how the market sees Amazon. Its price-earnings ratio, say 34.8x forward PE, is way higher than Walmart's 25.1x. It's also higher than Google's 22.4x or Alibaba's 8.5x.
So expensive compared to retailers or value tech.
Definitely. But its PE is actually pretty similar to, maybe slightly below, a high-growth tech darling like Microsoft at 35.5x. So the report concludes the market isn't pricing Amazon like a store anymore. It's pricing it like a premier tech company because of AWS, ads, and increasingly AI potential.
Got it. So the valuation looks high, reflects big expectations, but maybe justifiable given the tech components.
That's exactly the synthesis in the report. The DCF value, around $246, suggests it's trading, reasonably close to its calculated intrinsic worth. The relative view confirms its price like high-growth tech. So yes, the valuation is demanding, but the report argues it seems justified by the quality, the growth, the dominance. That leads them to their fair value range, $235 to $255 per share.
To justify that price and hold that market share, they must have strong competitive advantages. An economic moat, as they say. What does the report identify?
It describes the moat as wide, durable, and multi-layered. First, those network effects on the marketplace, more buyers attract more sellers, which means more selection, attracting more buyers. Classic flywheel. Second, huge cost leadership. Their scale in everything, fulfillment, data centers, buying power gives them cost advantages nobody else can really match. That enables the low prices and fast shipping. Third, intangible assets, the sheer power of the Amazon and AWS brands. Trust, quality, reliability.
Okay. Anything else?
And high switching costs. This is really big for AWS. Once a company builds on AWS, moving is really complex, costly, and risky. Prime also creates sort of softer switching costs for shoppers. The report mentions Porter's 5 forces analysis backs this up: high barriers to entry, especially in cloud, high switching costs for cloud customers.
Makes sense. What about qualitative stuff? Management, culture, things you can't easily put a number on.
The report notes the experienced leadership Andy Jassy, who built AWS, now CEO. Jeff Bezos still involved as exec chairman, focusing long-term. That stability and tech focus are seen as major pluses.
And that famous day one culture that I mentioned?
Oh, yeah. Called out as crucial. Fosters urgency, innovation, big long-term bets. Project Kuiper, their satellite internet project, is given as an example. Huge potential, maybe not fully valued by the market yet, what the report calls unpriced optionality. But maybe the biggest qualitative factor right now, according to the report, is their position in AI.
Everyone's talking AI. What's unique for Amazon?
The report really hammers this dual role. They are a key enabler of AI and a primary beneficiary. As an enabler, AWS sells the picks and shovels the cloud power, the AI services like Bedrock, the custom chips like Trainium that other companies need to build AI.
Okay, so selling the tools.
Right. But they're also a massive user of AI internally, optimizing logistics, personalizing recommendations, making ads more effective, developing products. They use AI everywhere to make their own giant business run better. This dual role, powering AI for the world and using it intensely themselves, is seen as a profound, almost unique growth driver.
That is a really powerful point. Okay, we've got the strengths, the model, the financials, the moat. But every investment has risks. What are the big ones flagged in this analysis?
The report is very direct here. Lots of risks. But the single biggest, most unpredictable one is regulatory and antitrust scrutiny. All over the world, US, Europe, elsewhere. Governments are looking hard at their dominance, their dual role as platform and competitor, their practices.
And what could happen? Fines. Worse.
Could be fines, which they can probably handle. The bigger, though maybe less likely risk mentioned is forced structural changes. Like, could they be forced to spin off AWS? It's seen as a tail risk, but it's the major uncertainty hanging over the stock.
Okay, regulatory is number one. What else?
Well, standard macro risks. A bad recession would hit retail spending, maybe slow down some IT spending affecting AWS. Inflation, interest rates, they raise costs for labor, transport, capital. Competition is fierce, obviously. Microsoft and Google in cloud, Walmart, Shein, Temu in retail, and just operational risks. They're huge and complex. An AWS outage, a big logistics mess up, a cyber attack, those are always possibilities. Labor relations, union pushes that could mean higher costs or disruptions. And the report notes their beta is about 1.3, meaning the stock tends to be about 30% more volatile than the market overall. Typical for high-growth tech.
Okay, so you weigh this incredibly powerful, unique company against these pretty significant risks, especially the regulatory cloud. What's the final verdict from this analysis?
The outlook. the recommendation. The outlook tries to balance the catalysts against those headwinds. Catalysts include really monetizing AI, both selling AWS AI services and using it internally, continued huge growth in high-margin advertising, margins structurally improving as those profitable segments grow, maybe eventually getting international retail to be consistently profitable.
And the headwinds are mainly that regulatory threat.
That's the primary one flagged. Also, AWS growth inevitably slowing down a bit from hyperspeed the pace matters. And just the risk of a prolonged economic slowdown hitting both sides of the business. So the report's conclusion is basically, yes, Amazon is this global titan, dominant moats in e-commerce and cloud, plus this powerful advertising engine, exceptional financial structure with AWS funding retail and that negative CCC, and critically, right at the center of the AI boom, enabling it and benefiting from it.
But the risks are real.
Absolutely. The risks, especially regulatory, are acknowledged as significant. However, the analysis concludes that the fundamental strengths, the market leadership, the clear growth runways, and that powerful financial model ultimately outweigh those challenges.
Which leads to the recommendation.
The recommendation provided in this analysis is BUY. The time horizon specified is 12 months.
And the core reason for that BUY call?
It boils down to valuation and future potential. The report's DCF value around $246 suggests meaningful upside potential compared to the fair value range of $235 to $255. That combination of secular growth in cloud and ads, expanding margins, plus that AI optionality, it's seen as enough to justify the premium price and overcome the risks, according to this specific analysis.
It's definitely a complex picture, far beyond just an online store, with AWS and advertising being so critical, and that negative cash cycle providing such a unique edge. You can see why the analysis lands where it does, even with the regulatory overhang. And thinking about that dual AI role, enabling AI for others while using it so powerfully internally, you have to wonder how much more could that reshape their finances in ways. Even this deep analysis is just starting to touch on, something to keep thinking about. If you found this deep dive useful for untangling a complex company like Amazon, and you want more insights like this delivered quickly, make sure you subscribe. It's the best way to get our fastest and most frequent dives.